Introduction. New York City stands as one of the most expensive real estate markets in the world. For decades, housing prices in this metropolis have defied conventional economic cycles. While other cities experience booms and busts, New York's property values demonstrate a remarkable resistance to decline. This phenomenon raises a fundamental question. What forces sustain these prices at such elevated levels, seemingly immune to the downturns that affect markets elsewhere? The answer lies not in a single factor, but in a complex web of economic, structural, and institutional forces that interlock to create an environment where housing prices remain stubbornly high. Understanding this requires examining the city's unique position in the global economy, its physical constraints, its regulatory framework, and the powerful financial incentives that drive investment in its real estate. Section 1. Geographic Constraints and Historical Development. New York City occupies a finite space. Unlike cities that can expand outward across vast plains, New York is bounded by water on multiple sides. Manhattan, the economic heart of the metropolis, is an island measuring roughly 13 miles long and 2 miles wide. This geographic reality imposes an absolute limit on the amount of land available for development. The city's development followed patterns established centuries ago. Streets were laid out, neighborhoods formed, and infrastructure built according to plans that reflected the needs and technologies of earlier eras. The famous grid system of Manhattan, established in 1811, created a framework that still governs development today. This historical infrastructure cannot be easily reconfigured to accommodate modern demands. As the city grew throughout the 19th and 20th centuries, available land became increasingly scarce. Developers responded by building upward, creating the iconic skyline that defines New York. However, even vertical expansion has limits, both physical and regulatory. The bedrock beneath Manhattan can support tall structures, but not everywhere, and not infinitely. The result is a city where every square foot of developable land carries enormous value. This scarcity creates a fundamental economic dynamic. When supply is constrained and demand remains strong, prices rise. In New York, this dynamic has operated for generations, establishing a baseline expectation that property values will not fall significantly, even during broader economic downturns. Section 2. The Regulatory Framework and Zoning Laws. New York City operates under one of the most complex zoning systems in the United States. Established in 1916, the city's zoning resolution was the first comprehensive zoning law in the nation. It divides the city into districts that specify what can be built, how tall structures can rise, and how much of a lot can be covered by buildings. These regulations serve important purposes. They prevent incompatible land uses from conflicting, protect neighborhood character, and ensure adequate light and air reach the streets. However, they also severely restrict the supply of new housing. In many desirable neighborhoods, zoning laws prohibit the construction of tall buildings or mandate low-density development that limits the number of units that can be built. The process of obtaining approval for new construction involves navigating multiple city agencies, community boards, and often lengthy public review processes. Environmental assessments, landmark preservation reviews, and community input requirements can extend project timelines by years. These delays add substantial costs to development, costs that ultimately get passed on to buyers and renters. Rent control and rent stabilization laws add another layer of complexity. Approximately 1 million apartments in New York operate under these regulations, which limit how much landlords can increase rents. While these laws protect existing tenants, they also reduce the incentive to build new rental housing and can distort the market by creating a two-tier system where regulated apartments rent for far less than market-rate units. The cumulative effect of these regulations is to constrain supply while doing little to reduce demand. This imbalance pushes prices upward and creates a market where even modest apartments command premium prices. Section 3. Global Capital and Foreign Investment. New York City functions as a global financial capital, and its real estate market reflects this status. Property in New York serves not merely as housing, but as a store of value for wealth from around the world. Investors from Europe, Asia, the Middle East, and Latin America view New York real estate as a safe haven for capital, particularly during times of global uncertainty. This international demand operates differently from local housing demand. Foreign buyers often purchase properties not to live in them, but as investments or as occasional residences. Luxury condominiums in Manhattan can sit empty for much of the year, owned by individuals who visit the city only occasionally. This phenomenon removes units from the active housing supply while sustaining high prices through investment demand. The flow of global capital into New York real estate accelerated dramatically in the decades following the 1980s. Financial deregulation, the growth of international wealth, and New York's position as a center of global commerce combined to make the city's property market attractive to investors worldwide. Major developments increasingly catered to this international market, with sales offices opening in foreign cities before construction even began. During periods of global instability, this dynamic intensifies. When other markets appear risky, capital flows toward perceived safe havens. New York real estate, backed by the stability of American institutions and the strength of the city's economy, becomes even more attractive. This counter-cyclical investment pattern helps insulate New York prices from downturns that affect other markets. The scale of this investment is substantial. Billions of dollars flow into New York real estate annually from foreign sources. This capital competes with local buyers, driving prices beyond what local incomes alone could support. The result is a market where prices reflect global wealth rather than local earning power. Section 4. Income inequality in high-earning sectors. New York City hosts some of the highest-paying industries in the world. Finance, law, technology, media, and corporate management concentrate in the city, bringing with them professionals who earn substantial incomes. The top tier of earners in these fields can afford housing costs that would be prohibitive for most Americans. The financial sector alone employs hundreds of thousands of people in New York, many earning six-figure salaries or more. When bonuses are included, compensation in finance can reach extraordinary levels. These high earners compete for housing in desirable neighborhoods, particularly in Manhattan and parts of Brooklyn, driving prices upward. This concentration of wealth creates a bifurcated market. At the top end, luxury properties sell for millions of dollars, sometimes tens of millions. These transactions, while representing a small fraction of total sales, establish price benchmarks that influence the broader market. When penthouses sell for $50 million, apartments several floors below can command proportionally high prices. The presence of these high earners also supports a vast service economy. Restaurants, retail establishments, professional services, and cultural institutions all cater to this affluent population. However, the workers in these service industries typically earn far less, creating a stark divide between those who can afford market-rate housing and those who cannot. Income inequality in New York ranks among the highest of any major American city. The gap between the top 10% of earners and the median household continues to widen. This inequality manifests directly in the housing market, where the purchasing power of high earners sustains prices that bear little relationship to median incomes. The city's economy continues to generate high-paying jobs, particularly in technology and finance. As long as these sectors remain strong, they will continue to produce residents capable of paying premium prices for housing, maintaining upward pressure on the market. Section 5. Infrastructure and transportation networks.